First of all, I want to clarify what you've said so far to make sure I've understood here. So,
Okay.
so essentially, your basic thesis is that like people shouldn't invest in a stock unless they look at the how the debt is trading. So you're saying that at one point, or maybe perhaps still, that the debt on AMC, for example, was trading at 1 cent on the dollar. So that means that they have bought, say, $100,000 of debt for for $1,000.
Yeah, let's use a million,
Okay.
right? So typically, if it's debt will trade in as low as $100,000 increments, but you use a million, and 1/100th of a million means you could buy $1 million worth of debt for $10,000.
Right.
Ooh,
Wow.
that's sort of cool.
Yeah,
You're
that's
buying the
that.
stock as an option, which could, skate its way into profitability. But until the debt goes back from $10,000 to $1 million, your equity purchase is for knuckleheads, retards. I don't know how else to say it. If you had $10,000 of capital to invest, where should you have put it?
Mm.
In the stock or in the bonds? The bonds at 1 cent. Dang, I know where I would have put it. Problem is, how many of your guys knew where the bonds were trading? No, it's not listed on an exchange. No,
Is it
you
open
don't
to retail
understand.
investors at all?
Pardon me?
Is that market open to retail investors whatsoever?
You have to be tapped in, yeah, but no, not generally. That's the difference. Bonds trade OTC, over the counter.
Yeah. Yeah. So right, say I was tapped in, right, theoretically, in January, and I had decided that GameStop was a really great company, but the debt was trading very, very poorly, or that AMC was a really great company, and I expected it to survive the current prices of the stock going
Okay.
on thing. And I went and saw, okay, I'm going to buy the debt. Like, at what point? So this is what I'm not. I can't pretend to be well versed in bonds. So
Yeah.
then say so you're buying the bonds of the issued by the company in order to raise capital. When can you say
No, sorry. The company was not raising money at 1 cent on the dollar.
no,
The
no, no, no?
company
I,
had
I got
issued,
that.
right?
Yeah, so
Okay.
they've issued it, and the bonds sort of go in. So say they issue, let's say $1 million in bonds, and then the
No, a
bonds
hundred million,
a
and
hundred million.
the total value of 100 million was trading for $1 million.
Okay, so say we that's happened. It's gone out into the market. It's now been valued by the market at 1 cent on the dollar, and then what point can the investors who buy that get their money back? Like, can they force it back, or does the company have to decide they want to buy those bonds back?
Oh
And
no, I mean the market trades on a secondary basis, but what you own is a contract, right? This is a contractual obligation for the company to pay you back.
okay,
And there's a maturity on it. And sometimes the companies can get actually smart and say, dang, I'm going to buy it back myself, right?
mm-hmm.
And I'm going to retire $100 owed at $1. Seems like a smart trade for me, but most CFOs don't even follow the trading of their own bonds. It's really, really, Josh, it's really a misunderstood asset class. And it's not, again, it's just underfollowed by everyone except sophisticated institutional investors, including the CFO of that company. Imagine if he had, $1 million just sitting on his balance sheet. Wouldn't it have been wonderful to retire $100 million obligation with $1 million of cash on his balance sheet? But
Yeah,
he probably didn't even have a clue that the bonds were trading at that level. And how long did they trade at that level? It doesn't matter. It hit $1. What if it's traded at even at 10 cents on the dollar? You'll still have a tenfold increase in the value of your investment before the equity claim is worth anything. Now, the equity claim becomes an option over time. And as that debt price increases, the value of the equity increases in lockstep because it's an option that it'll be able to pay back the $100 and then any residual cash flows accrue to the equity. That's all it is. It's a splitting of the cash flows that a company earns between its contractual obligation, which is the debt, and It's equity holders, non-contractual, but they are the residual. They get all the upside. A bond will never pay more than its coupon. Oh, things are going really good. We've decided to increase the coupon to the bondholders. No, that doesn't happen. All of that accrues to the equity guys. But the flip side's also true. If things are going south, the guy that recoups his money first is the bondholder. The equity holder is not entitled to any residual claim unless the bonds are made whole.
Okay, this is like making fabulous amounts of sense, actually. It actually makes a lot of sense in because so earlier in the year, GameStop bought back a whole bunch of they cleared a whole bunch of their debt.
Smart.
So yeah, but I hadn't put together like what the like. Okay, aside from a company not wanting to have the debt, obviously that's
they don't forget. Every single CFO in a going concern business should use leverage to a certain extent because that leverage enhances the return to equity investors. Why raise more equity if you can raise fixed coupon debt at a lower cost to your capital base, and that lower cost accretes to your equity holders if, in fact, the investment you make with the bonds earns money for the enterprise, right? Yeah. That's it.
Thanks for making it all the way to the end of the video. Don't forget to like, share, subscribe, and leave a comment for us in the comments below. Let me know what you thought and if you'd like to see more of this from the show. Thank you, and we'll see you again next time.